Thank you, Curtis. Good morning, everyone. My name is Brian Tomlinson. I'm a Senior Research Advisor to the Strategic Investor Initiative. Delighted to introduce the next speaker, Katie Schmitz Eulitt, who is the Strategic Advisor to SASB. I met Katie last year when we were preparing our respective organizations' responses to the SEC's concept release on Regulation SK. All 320 pages of it, not just the 13 reference to sustainability. So it was a big job and something of a bonding exercise. Katie curates the highly regarded ESG integration insights that SASB produce, and also co-curates their Power Pact investor advisory group. She's a phenomenal advocate for the SASB framework and for sustainable business practices generally. So it's a personal pleasure to introduce Katie Schmitz Eulitt from SASB today. Thank you.
Thanks very much. Can everyone hear me? I think this is on. So thanks CECP for inviting us. Thank you Bloomberg and Curtis for your support. And I'm going to take a very different approach to explaining what we do, and it's sort of zooming back out to the 30,000-foot level. My talk is supposed to be about trends, and one of the trends that I'm seeing as SASB reaches the stage of codifying our standards is the big question is, why do we need this? So I'm taking this from the perspective of infrastructure, and this is an overview of the Bay Area, which is surrounded by water, as New York is, and drawing some parallels between physical infrastructure and financial markets infrastructure, and showing how SASB fills a gap here. So the Bay Area is surrounded by water. We started off with a lot of ferries. Then somebody had a great idea, like, why don't we build a bridge to span the Golden Gate, which we did, and it's great. Then they built a bridge to span the East Bay span, and then that wasn't adequate to carry people across the bay. So then there was an idea of, why don't we tunnel underneath the water and build this great system, which they did. Now we have this great system that connects everyone. And there's been a similar transition in financial markets infrastructure that we often take for granted. And the reason I'm using infrastructure as a metaphor here is that we only notice it when it's broken or not working well. The financial markets in the US, trades used to be conducted at the curb under the Buttonwood Treaty, which led to somebody saying, you know what, we should have a better system here. The Buttonwood Agreement brought us the New York Stock Exchange over time. NASDAQ arose in the 70s to fill another gap. So we see that there's been this evolution over time. So today investors have comparable, decision-useful information at their fingertips, but it has not always been that way, and we take that for granted. And so SASB is trying to fill a gap that I'm going to be explaining to you further. So this road to comparable decision-useful data has been a long one. I won't go to the 3000s to taxes on stone tablets or double entry book keeping. But we started to see a corporate form emerge in the 1800s. We didn't start to see sort of an organized accounting profession until the 1900s. The SEC was established in the 1930s. And we didn't really get an accounting principles board until the 50s, and all during this time, from the 30s to the 50s, we didn't have standardized financial reports. We didn't have a means by which we could communicate in a common language to what was really happening with corporate value. We had research bulletins, we had APP bulletins, but it wasn't until the advent of the Financial Accounting Standards Board in the 70s and the advent of General Accepted Accounting Principles in 1973 that we got any common way of communicating how companies were creating value, or not even creating value, but what their value could possibly look like. So before all of this, investors waded through journals. They literally had to read page after page of the Wall Street Journal, of Forbes, Barron's, and other publications that really didn't have a lot of common language. It was sort of the Wild West. And the tone and attitude of corporate communication with investors was really quite different. One of my favorite quotes from Henry Havenmeyer, who was the president of the American Sugar Refining Company, which was the largest sugar company at its time in the United States, justifying his refusal to disclose any financial information whatsoever to his investors, said, "I won't wet nurse you. You've got to wade in and get stuck." Wow. So there we have it. This opacity of information and inflated corporate value, misleading financial reports, is it attributed to the financial collapse and the stock market collapse of 1929 and what followed. So we have GAAP. We're following along. Everyone's, submitting their financial reports to the SEC. But the world has changed quite a lot since the 70s when we got GAAP. The world population has doubled since then. Megatrends that are causing us to rethink how we manage finite resources are on everyone's mind. We have a far more globalized world than we had back then, and a world in which we're far more interconnected, and information travels around the world in seconds. So one misstep in a highly complex supply chain, which we now all have, how you're managing community relations, wherever you're operating, all of this information has put everyone on a very different footing, but we're still using the same sort of narrow focus financial reporting system that we've used previously to communicate to investors how you are creating long-term value. The composition of market value has also changed substantially since the advent of GAAP, when in 1975, 80% of a company's in the S&P 500 market value was tangible assets, whereas today it's absolutely the inverse. So it's really no surprise that investor views have changed. In the 1970s, the SEC determined that an insignificant percentage of investors really cared about these issues, and so there was really no need to do anything different about the way that they guided companies to report their information out to investors. And as Curtis noted, that has really changed. So today, 90% of the top 100 asset managers globally has committed to evaluating ESG factors in all of their investment decisions. All of them. So this is not sort of the boutique investment firms that you might think of, although they've played a very important role in this transition. They're the BlackRocks, the Goldman Sachs, State Street, Bank of America Merrill Lynch. Each has an ESG integration platform, ideology, looking at long-term investment strategies. State Street, and you'll hear more about a co-author of a very excellent piece called The Investment Enlightenment, looks at these issues as long-term value creation. The head of U.S. equities and quantitative strategy at Bank of America Merrill Lynch said, "I've never seen anything as effective as ESG characteristics when it comes to anticipating future earnings or the volatility of U.S. corporations." So getting back to infrastructure, things are not quite what they need to be. Although we've gone a long way from 2011, when only 20% of S&P 500 companies issued sustainability reports, to today, where we're at 82%, which is fantastic. Investor satisfaction with the information they're getting has not been satisfied. Or we haven't given investors what they need. There's tremendous disagreement about the quality of sustainability information that we're seeing, where PwC surveyed corporations and found 100% of them were very confident in the information they were providing, but only 29% of institutional investors had a high degree of confidence in the quality of the information they were receiving for all of these different reasons. They couldn't understand how risk and opportunity were affected in business models. They couldn't quantify these things in financial terms. They couldn't compare companies easily. They didn't have KPIs that they understood. And the lack of a standard for communicating this information to investors was a number one problem for them. So it's no surprise that we've seen sort of a little micro infrastructure build up around this information. How do we communicate to investors who are really dissatisfied with the quality of the information that they're getting? So we have hundreds of organizations evaluating your companies on hundreds of metrics, whether you're filling out questionnaires or not, and they're still not getting the information that they need. So what we see, in my opinion, is that the current state of sustainability reporting is quite similar to the world pre-GAAP that we had with financial reporting, where it's difficult for investors to get from where they are to where they want to be. They want material industry-specific information. State Street has said these issues of financial performance affect in specific ways that vary by topic and industry, and we would agree with that. And a market standard is needed to improve the communication between issuers and investors on this kind of performance, and SASB bridges that gap. It's a shared solution to a shared problem. And Harvard Business School research supports this, supports the notion that not only, and to Curtis's point, is this the right thing to do, but it's also good for companies to do, because companies that focus on material issues and don't focus on immaterial issues outperform their peers significantly. The study also found that 80% of what's currently reported in those sustainability reports is immaterial, which doesn't mean that it's not important to a wide group of stakeholders. Those are significant issues, but they don't show evidence of impacting the financial or operating performance of a company, which is what SASB is focused on. Which is why you're seeing letters like this from BlackRock's CEO focusing, saying, we think that these things talk about and help us understand better the long-term prospects of a company, which is why just a week or so ago, Bill McNabb, the CEO of Vanguard, talked about why they are involved in SASB's investor advisory group. Because again, materiality-driven sector-specific disclosures better illuminate risks in a way that aid markets' efficiency and price discovery. So that's what SASB is striving to help companies do, is to communicate that. And this is, these are all the members of our investor advisory group, all of whom not only have committed to evaluating ESG in all of their investment decisions, but they've all committed to encouraging companies to communicate with them in the language of SASB. So I like to think of this as DNA fingerprinting for your company in a given industry. And you'll see kind of the visual similarities between a DNA fingerprint and the SASB materiality map, all right? So, and this is an interactive map. It's on our website. You can click through from a sector, which will open up to show all the industries underneath it, and then screen along a variety of different ESG factors to say, right, I should be thinking about something here. Actually, fuel management is not a big deal for a pharmaceuticals company. So it's a very quick way of assessing where you might have risk and opportunity and how you might want to be looking at that in your strategy and then communicating that out to your investors. SASB has filtered hundreds of sustainability topics by industry, mapped them to value drivers that you would want to be managing in your business, and then translated that into topics and metrics through which you can communicate how you're managing those things, both internally and then again out to your investors. And it's SASB's focus on those issues that affect financial and operating performance as well as the rigor of our process that yields information that investors value, which makes this information fit for use in SEC filings, which gives companies the ability to regain control of their story when it comes to how they're performing on these factors that investors increasingly care about, so that they can communicate in a way that enables peer comparisons in complete data sets, enabling benchmarking, and in consistent units. So this is a future perfect state that we envision when more companies begin using SASB to communicate to investors on their value. We often hear when people look at SASB standards, well, these are just business issues. I don't see sustainability issues here, but that's exactly what we're talking about. These are business issues. They affect corporate value and long-term value creation opportunities, and they're in the news every day. And SASB gives you sort of a guide to show you, oh, in my industry, I really ought to be focusing on these things. I don't know why that's in there twice. So I like to think about SASB as a bridge that we've built parallel to the other infrastructure that's out there to give you a way to communicate to your investors on these issues that they really, really care about. We have talked at SASB a lot about communicating these issues in SEC filings, which we submit is this information, and SASB's process makes this sort of designed for purpose in SEC filings. But there are long paths, many pathways to getting into your SEC filings, but investors are seeking this information sooner than later. So whether you write a standalone SASB report, which JetBlue did this year, issued just a SASB report for investor communications when they had other communications on other sustainability issues elsewhere, or if you use SASB as a table in your existing sustainability reports, as Energy has, as ArcelorMittal has, as other companies have been doing, or whether you use it to improve your disclosures in your SEC filings. And by the way, 60% of companies are referring to SASB disclosure topics in their SEC filings, but they're using boilerplate, which irritates investors. All of these are valid uses of SASB standards, and we encourage you, when you hear from investors, which I think you will increasingly begin to hear from investors, we'd like this information. Think about where you are on these paths, and I would encourage you to take a look at the standards for your industry, to comment during the public comment period, which will be open at the end of the month, one last time before standards are codified. And even if you're only looking internally at how these things affect your business, I hope that you will view SASB as new market infrastructure to meet issuer and investor needs.
Thank you very much, Kate.